Hi, everyone. This is Jason Burek of Wall Street from Main Street.
And Lee Justo from Risk.
Welcome back to another episode of Finance Unspun. This is episode number 22. Lee, we haven't done a show in about a month. I know you've been busy running your small business. Obviously, we're not getting paid a lot of money to do this show, but thank you for coming on Tuesday, August 8th, 2023 to record another show with me.
Oh, it's always a pleasure to do a show with you, Jason.
Hopefully you can fit this into your schedule more often. I know it's difficult because you run a small business and that pays the bills. So we'll see what happens in the future with either a new business partner or I move on. And by the end of the year, I'm not quite sure yet how things are going to play out, but I honestly don't really want to be doing that much more free content either. So we'll yeah, I'm tired of working for free.
Yeah,
and I have expensive medical bills and I'm getting killed with inflation and taxes, small business taxes, and my bills are up with grocery too, which pretty much everyone is dealing with after over 12 months of the Fed rate hikes and stagflation and shrinkflation and all this craziness. Despite the narrative going on that the Fed is controlling inflation, the rate hikes are working. I'm seeing these ridiculous headlines, Lee, that the Fed has saved the economy, that the Fed and we still have a bull market in stocks and all this stuff.
I remember back in the tech bubble days, pre-crash, Alan Greenspan could walk on water back then in the press, Same kind of thing now. And I think we're all feeling the squeeze, probably more now than we were maybe a year ago.
Well, I think Greenspan could get away with a lot more back then. I think things are starting to come unraveled very, very quickly with all the problems in the real economy. We're seeing just insane numbers in terms of credit card debt, interest payments on debt, problems with the banks. Last week, we had some really interesting topics. We were going to record a show last week, but we had some scheduling conflicts. So we'll talk about that. I think, Lee, we're finally now after the fastest pace of rate hikes in Federal Reserve Bank history. So yes, interest rates are not at all-time highs or anything like that. However, this is the fastest pace of rate hikes in Federal Reserve Bank history. So the economy, so all the businesses, the hedge funds, the large banks, the consumer, it's been a Pavlovian response for about 15 years because of zero interest rate policy. A lot of businesses and consumers and hedge fund managers and banks overborrowed, thinking that interest rates would remain artificially low. And then when interest rates went up, now you're seeing the lag effects finally after over 12 months of Fed rate hikes, when the majority of market participants and people in the real economy, consumers, et cetera, even governments, were not prepared to deal with interest rates at these levels.
No, I mean, this is basically the classic Austrian school argument of how, excess credit leads to malinvestment. And then what was that quote you said before about Mises was great. You got to repeat that one, running over the body.
Okay, so von Mises used the analogy of with the Austrian theory of the business cycle, the artificial boom followed by the bust. The artificial boom is actually the bad part. So a lot of people don't see it as the bad part. A lot of people see the rate hikes as the bad part. But the artificial boom actually causes a lot of the problems. But von Mises used the analogy that the rate hikes, because the Fed is not, these are PhD economists. They don't have a good track record in the real world. Very few of them actually have had any jobs in the real world. A lot of them are just academics or government employees, or basically grossly overpaid bureaucrats that fail forward via the Peter principle, like Janet Yellen, who somehow missed the entire housing bubble while she was at the San Francisco Fed in the last cycle in 2005. She missed the entire housing bubble. But anyway, though, these people, they see the only tool for the central bank to quote unquote fight inflation is to either raise interest rates or reduce the Federal Reserve Bank's balance sheet. So to quote unquote fight inflation, they just kept raising interest rates. Well, when you have all these market participants and governments and people in the economy, consumers that are trained on lower rates, and you start to rapidly raise interest rates, you're going to see immense problems. You're going to see bankruptcies. You're going to see defaults. And we're just starting to see that now. With the record pace of, I think, small businesses that are on pace that have either filed for bankruptcy, where I think we're on a rapid pace for 2023 for 2023 so far. 2024 may be even worse unless the Fed starts to cut rates or they come up with a new bailout or liquidity program. and then the amount of credit card debt. But the stories we saw last weekly, we had Apple miss on total sales of the iPhone. I think that has to do with credit, because a lot of people, and I've spoken with people at those at the telecom stores that sell the expensive smartphones, and they were just shocked when people come in and either pay the entire amount of the bill for a new iPhone or a new Samsung phone or one of those expensive smartphones up front, because the majority of people for years now have been paying just higher monthly payments on credit. So pay as you go, buy now, pay later, just higher monthly payments.
Yeah, no doubt about it. I mean, hey, I think the biggest canary in the coal mine is the Yellow bankruptcy. I know it's more complicated than the economy with the union and everything else, but I think if the economy was booming, they would not be facing a bankruptcy, no matter what other issues they're having.
Well, I think it's more complicated than just the interest rates going up, because they were kind of forced to take out a $700 million pandemic loan in 2020, and then there was problems renegotiating with the Teamsters and the unions, and then they were re-dealing with supply chain problems and higher fuel costs. I mean, they had to deal with higher fuel costs.
Of course.
But when they got that pandemic loan, I think the shares went up a lot, their shares initially, but then the management team didn't refinance the debt, and then they couldn't get any concessions from the union. It's just a disaster, though, because now a lot of people are going to be losing their jobs. So it's just, and then their pensions too. So it's just a total mess. You can't blame it all on the higher interest rates, but
no, you can't. But my point is that if we had a booming economy, they would have been able to survive all these other issues. And I think that they're not the only company we're going to see in that sector go this way over the next 12 to 18 months.
Well, the narrative on the mainstream financial media, is that we have a real bull market. I mean, at best, I think it's a bear market rally. There's just a lot of signs in the real economy that the asset markets, with the shadow liquidity programs, quantitative easing from Japan. So these shadow liquidity programs from the FHLB, the BTFP, the Fed's discount window, that liquidity did not end up in residential real estate like the FHLB was supposed to. That liquidity ended up, in my opinion, in the US stock market. There's actually only two major stock market indexes in the global macro picture. That's Japan's Nikkei. And I think a lot of that is a combination of the quantitative easing from the Bank of Japan, and then also a devalued Japanese yen, their currency. So they're having more inflation than they're used to, at least for official government numbers. They've had a lot higher inflation and stagflation and shrinkflation, because I have Japanese listeners over the years sending me pictures of the grocery store items that have shrunk drastically, that have not been included in their official government inflation data. So you have only two major stock market indexes the last 8 to 12 months that have had big rallies. So that's the US one, and that's 7 stocks. So that was not exactly the thing, but more or less.
Yeah, well, it definitely wasn't a broad rally.
Yeah. So you have and then they rebalance the indexes for the NASDAQ to try to make them. So it's the large cap, big tech stocks that are similar to the FANG stocks, give or take a couple, not including NVIDIA. So NVIDIA is one of the major ones because of the AI bubble. But then the Apple missed last week. So Apple didn't hit the number of iPhones. And then the other
Apple stock chart does not look very good. Jesus, I don't know if you've looked at it, but it does not look healthy.
Well, I mean, they've been doing financial engineering for years. They've been doing the share buyback with debt, loading the balance sheet with debt. They have a moat. Yeah, they have an ecosystem where a lot of people don't want to switch the cloud storage and their music and their photos. They don't want to switch all that stuff over to Microsoft or another competing company.
Yeah, no, they definitely have I'm sorry. Go ahead.
Well, they're not doing the type of innovation they used to in the past with Steve Jobs, where they're coming out with all these new products and they're creating new markets for hundreds of billions of dollars or $1 trillion. They're not doing stuff like that anymore. I mean, it's a slow growth company. They have a moat though, but the financial engineering with all the debt and the share buybacks with debt, loading the balance sheet with debt, with corporate debt, there's red flags there. It's not we'll have to see what happens with the Fed and interest rates. But my point though, that was one of the major stories last. So that really spooked the market. I mean, there was a lot of major institutional investors. When Apple missed, they started to offload some of their other shares. The other major news story that came out last week that a lot of people were not talking about was the Fed survey of the bank chief financial officers and the senior executives, who all said that they are going to be drastically reducing the amount of loans outstanding in credit. So historically, Lee, credit contraction. So the banks tightening credit standards drastically. And this is not by a little bit. This is substantial credit contraction standards. That normally means the banks are hunkering down. They're raising cash. The banks are going to stop trusting each other. The banks are going to stop trusting consumers for loans. They're going to stop. So credit card loans.
That already is, to some extent, has happened. There's we're starting. I was going to say the auto loan rejection rate is at the highest level since the Fed started collecting data in 2013. It's like 14.2%. And then also the overall loan rejection for applications was 21.8%. So that is also very high. So they were already clamping down on credit,
Well, but is it too late though? I mean, look at the total amount of credit card debt outstanding.
Oh yeah, it just hit 1 trillion.
At very high interest rates. So the average credit card balance, I think, for Americans now is close to $6,000 and that's over the average interest rate that the American with that type of credit card debt is paying is over 20% now.
I was going to say it's got to be at least 20%. So just imagine what 20% on $1 trillion is. Oh my God.
And for our listeners out there, that amount of credit card debt, because I was watching Fox Business in the early afternoon, that credit card debt is up 15% over the last 12 months. So year over year. So that's a 15% increase in credit card debt. I would argue that that's about the real inflation rate. So that was about the real inflation rate, at least last year in 2022. So the consumer was putting a lot of their standard of living on a credit card. Now, we could argue about how sustainable that is for some people, but for a lot of Americans who don't have high salaries or their wages are declining or their small business is not doing well now and they're looking to cut back, downsize, or they just got fired or laid off, they're not going to be able to maintain that type of credit card debt, that type of standard of living. It's going to be tough for them to pay back that credit card. So you're going to start to see a lot more defaults and things like that. And I think that's why today, Lee, on Tuesday, August 8th, 2023, earlier in the afternoon, we had the ratings agency Moody's, and they just downgraded, I think, 10 banks, mostly regional banks or medium-sized banks here in the United States. And I think they put another 6 to 10 banks on a potential credit downgrade watch list.
It's not a good time to be in banking when they're raising interest rates as fast as they have. So did you see that KKR acquired $373 million of auto loans from Synovius Bank? They just did that deal. I wonder what KKR is thinking.
I did not. Normally, these loans in the past, the Fed would wait for these things to crash. And then the Fed would go and give like a hedge fund or BlackRock or one of these.
Sweetheart deal on
Bingo.
It.
Bingo.
No,
but
that happened with Silicon Valley Bank just a few months back.
Well, also JP Morgan also got to buy First Republic. They got all the good assets for literally pennies and none of the toxic liabilities. So the taxpayer got stuck with all the garbage.
I found an interesting statistic online today when I was researching some of the debt. And there's this website, Money Geek. I don't know how reliable it is, but they're reporting individuals over 75 and older hold most of the debt. So that's basically the baby boomers.
The younger generation, so the millennials, Generation Z, millennials, Generation Xers, I think they have a lot of student loan debt. Some of them, depending upon what
they said in the stat that under 35 the least, but that kind of makes sense because under 35 most people don't own homes, or a lot of them don't own fancy cars. I mean, yes, student loan debt is definitely an issue.
I think a lot of them have credit card debt. So I think it's credit card debt for the younger adults. It's credit card debt, student loan debt. Some of them are trying to pretend that they're very affluent. So they might be paying $1,000 or more a month for a car loan. I've seen a lot of that stuff going around in financial. Well, I'm not sure if it's not Twitter anymore. It's whatever Elon Musk decided to rebrand it as. It was financial Twitter. So there was like screenshots of like these TikTok influencers talking about how they hadn't paid their $1,000 a month car loan payment in over 3 or 4 months.
Wow. repos must be going through the roof. One of the things we wanted to talk about was retirement accounts. And Vanguard is reporting hardship withdrawals at the highest level since 2004. So that's worse than like the height of the COVID. And also, the reporting that 401k loans are near record levels.
Okay,
Around when the Great Recession was happening.
You also had this is liquidation. So
Yep.
people are liquidating their retirement accounts not necessarily because they want to, but because they have to. So it's either to maintain their standard of living, or their adult children had to move back in with their parents. You're seeing a lot of that in the data, or they lost their job, or they can't get a job, or they can't put a even a life together with 2 or 3 part-time gig jobs, especially now if the government's going to tax part-time jobs or gig jobs at a much higher rate now with a higher self-employment tax and all that stuff. So you're just seeing a liquidation. The data for the retirement account articles that we wanted to talk about, 2022 and 2023, you saw the boomer generation or older, that they were selling a lot of their stock portfolio and other assets, and they were even willing to pay what the higher tax penalties, right? So if they couldn't get the hardship waiver, they were still willing to pay the higher penalty to tax out and get cash and access to it to pay bills or maintain your standard of living. And Lee, I would say that is not a sign that the real economy is very healthy. And this is a point that we've been talking about for pretty much every single show, is you have the asset markets and then you have the real economy.
No doubt.
It just gets more and more dislocated because governments and central banks, especially the U.S. government, because the U.S. government over the last couple of decades, really since the 1990s, has become, and it's gotten worse every decade, has become more and more reliant on tax revenues, capital gains tax revenues on stocks, bonds, and real estate via the Cantillon effect and central bank balance sheet expansion.
I mean, and that game can't continue on forever. It just can't. So I don't know if you saw, Moody's also cut the credit ratings of several mid-sized and small banks, which just goes along with the whole story we've been talking about this episode.
Well, I brought that up a couple of minutes ago. Actually, I thought you were going to bring up how Fitch downgraded the U.S.
Oh yeah, that's a big one. Let's talk about that. I mean, we talked about downgrades in the past and the severe consequences that those rating agencies faced after.
Yeah, I'm not sure. I mean, Fitch, they could threaten to fine them. They're one of the 3 major ratings agencies. So you have Standard & Poor's, Moody's, and Fitch. And the government has threatened them in the past with fines or removing there's a charter. So for the listeners out there, there's specific charters for the 3 major ratings agencies. I'm not sure if he still owns a lot of these shares, but Warren Buffett used to be a big buyer of the ratings agencies because he viewed the charters that they get from the government as basically like a large economic moat, as like kind of a well-protected government monopoly. So if you go and read old value investing books or Benjamin Graham and Warren Buffett, old school value investing, you'll read about like consumer monopolies or government protected monopolies, and Buffett likes to invest in those. But I mean, the thing is, if it's a government protected monopoly with a license or something like that for a specific thing, I mean, if they piss off the government could take it away very quickly.
Oh, of course, absolutely. There's always consequences when you go against the government, unfortunately. They just have way too much control over things.
Yeah, and that's what happened to the independent ratings agency Egan-Jones back in 2011. Now Fitch is way larger. So yes. Moody's is very, very large too. Moody's is what downgrading some of the regional banks. I think they threatened some of the larger banks. I'm sure they're getting lots of nasty phone calls and emails with threatening to credit downgrade the larger, too big to fail banks right now.
Yeah, no doubt. Well, I mean, the risk is out there.
Yeah, maybe Jamie Dimon will take his private jet over and have a nice talk with a couple of the CEOs there. If he's not too busy planning his presidential run. I mean, is he still planning on doing that?
Oh, who the heck knows? Oh boy! And
can he fit it? Can he fit it in his schedule in between vacations?
With all this stuff going on, I saw today on CNBC that Jim Cramer sees more positives than negatives in the market ahead, citing economic growth with little inflation. I think everyone listening to this realizes that the inflation is much worse than people
That's probably a contrarian indicator that we're getting close to the stock
always.
market top. Yeah, with the
Kramer always is a contrarian indicator.
Well, as we've been talking about in the last couple shows and my other interviews with other experts, historically from a financial history perspective, and this is just because a lot of people in finance that are hedge fund managers or bankers are away on summer vacation for the majority of months. So sell in May, come back after Labor Day. I mean, the risks are very, very high for stock market crashes historically in mid to late September and October.
Right.
So
I mean, I can conceivably see the market rallying over the next like month or so into September, and then hitting some speed bumps.
Well, let's see how many more banks fell, because a couple weeks ago you had the other regional bank that people were worried about the most, the one in California, PacWest, and there was a shotgun wedding with another regional bank, I think Bank of California, even though Bank of California is smaller. So there was some private equity capital to put some more equity back in. I don't know how involved the government was, or the Federal Reserve Bank and FDIC, and maybe doing some type of sweetheart side deal, but the large too big to fail banks weren't involved in that deal, at least not yet. So we'll see what happens with that. But there's a lot more pain coming. I think our point here is that there's a lot more pain coming from the banks. I was actually just watching a video that George Gammon did, where he was talking, showing the presentation for a very experienced real estate investor, Ken McElroy, and they were going through all the math of deals for multifamily. So this isn't even commercial real estate. Now the problems are starting to spill because of higher cost of capital, higher interest rates. And investors are saying, hey, wait, why do we need to take all this risk in the stock market with low dividends, companies with lots of debt, when we can go get almost 5% or close to 5% from US treasurydirect.gov, go and buy treasuries or money market funds. And that's what's happening. And so like these multifamily residential real estate deals, which are entire apartment complexes, these things are the math just doesn't work anymore at these interest rates, and the consumer out there, the people don't want to pay the rent, and maybe the government's going to subsidize the rent. I don't know. We'll see.
Yeah, we were talking about all the new immigrants into the country and flooding the residential real estate and being funded by the federal government. You said in San Francisco they're paying up to what, 120 a year?
I think so. I think if I remember correctly, unless the state of California and the San Francisco area changed the laws for that, if you made $120,000 a year and you were either a permanent green card or you're an illegal immigrant, you could get subsidized rent fully covered by the San Francisco government out there in the state of California if your income was below $120,000 a year.
Wow.
And people are like, well, why hasn't real estate crashed? Well, the government's subsidizing this stuff. And
exactly.
Are people if people have a mortgage locked in at a 30-year mortgage locked in at rates from years ago, at 3%, do you think they're going to sell? The very few, right? Unless they're forced to.
Of course, which could quite conceivably happen if the market really starts to go south.
Well,
so, we have
what
this.
you're seeing. Sorry to interrupt you. Let me just add one more point here. What you're actually seeing instead of people selling, Lee, is you're actually seeing a spike again. And this is sad, but this is what people are doing. They want to maintain their standard of living, or their adult children are moving back in with them, according to the data. You're seeing people who do have that mortgage locked in at 3% and property values are still relatively high. You're starting to see here in the United States spikes again in home equity loans.
Yeah. Yeah, of course, that makes sense.
So rather than
for those who can get them.
Well, so rather than people selling, my point here is that, like, a lot of people, because of the interest rates, and I have friends who have been predicting this for a while. So like my buddy Dave Kranzler, he's been predicting that real estate prices would crash. But a lot of people don't want to have to sell a home that they bought locking in a 3% mortgage, 30-year, and then go and buy something with a more expensive mortgage. So instead, people are going to say, well, I'm going to keep the property as long as property values are high. I'm not upside down on my equity. I can still pay the mortgage. It's locked in at a low rate. I don't want to go buy something at a higher interest rate and mortgage. Mm-hmm. Instead, they're just going to, if they want to maintain their standard of living or need cash, they're going to look to home equity loans first.
We have the CPI coming out there. Is that right?
I don't even care anymore. I mean, the base effects, the changing propaganda. I don't care about the phony government number. I mean, it's like it's basically to the Soviet Union levels.
Oh, it's beyond that, because people still have faith,
Well, I mean, the headline number just fools the algorithms, right? So if you actually if you spend like 10 minutes looking through the actual numbers, you'll see they made all these adjustments, geometric weighting, hedonics. The actual numbers are heavily adjusted. So if you just read below the headlines are saying, oh, the inflation rate's down. But if you look at all the numbers, you're like, none of the numbers are even close to that. So they just made a bunch. These are PhD economists making adjustments, doing bullshit modeling, and making a bunch of bullshit assumptions, the base effects, and all that garbage. It's just ridiculous.
Yeah, I mean, it's these totally self-important, overly confident academics who just don't live in the real world, and they think they can control the behavior of billions of people in the world. It's insane.
Well, we have too many PhD economists. The Federal Reserve Bank has many thousands of PhD economists on staff. The average person doesn't know this. There was a slip up a few years ago. I can't remember if it was Danielle DiMartino Booth or someone else, but it came out that the Federal Reserve Bank spends billions of dollars per year on research from academic papers. So they overpay PhD economists at universities and think tanks for ridiculous academic research studies. And then they have a staff at each Federal Reserve Bank of many thousands of PhD economists that they honestly don't need.
And these academics are pushing out papers that are favorable to the powers that be. They're not putting out stuff that makes things look bad.
Reverse financial engineering.
Yeah, exactly. So, do you want to talk about oil now a little bit?
So we've had the oil price rally. I mean, we've been predicting this for months. Remember our January show? Our listeners can go back. So you, me, and Aaron were talking about this in January when oil prices were weak, and the hedge fund managers were all starting to pile in oil shorts and said oil's going to crash even more. Oil's not going to rally for years. And we're like, no. OPEC's either going to cut, or you're going to see the rig count just collapse. So the rig count's already down around 14% from the November 2022 highs. The other important thing is that the Strategic Petroleum Reserve oil sales, those things are slowing. So notice if you correlate with the pace of the sales for Strategic Petroleum Reserve oil sales, they can't continue to sell all the oil from the Strategic Petroleum Reserve indefinitely. They were going to run out of oil.
Yeah, I was going to say there's only so long you can go with that.
And this is dumb policy anyway, because the oil is not supposed to be used in the short term to manipulate market prices. And yet that's what's happened the last 18 months.
Isn't that shocking?
Well, I mean, we have tons of financial engineering. We have financial warfare with the non-G7 countries and the BRICS. I think in the next couple of weeks, we're supposed to get an announcement from the BRICS. We'll see what they announce publicly. But the oil market, the problems, Lee, and I think we highlighted this in January, that in the short term, we predicted that the oil price back in January was going to be weak for a couple more quarters. A lot of supply would come offline. OPEC would debate more cuts. OPEC did more cuts. And not only did they do more cuts, their production quotas, they're not even anywhere close, a lot of the OPEC countries. So their production is way below the quotas now. And then you're starting to see a lot of problems and with the non-publicly traded exploration and production companies in the Permian Basin, the shale producers. Yeah. So these are the ones that have shale wells that are rapidly depleting, and they're not publicly traded, say like a Pioneer Natural Resources, a Sandridge Energy, and EOG Resources. They're nowhere near the size of a Chevron or an ExxonMobil. So their cost of capital is way higher. And what you've seen because of these interest rate increases, because of the cost of capital. So the average investor is going to say, I can get close to 5% risk-free from US Treasuries or money market funds. Why should I go and give this oil company that's not publicly traded, that has rapidly depleting wells, the oil price goes up and down a lot? Why should I take on all this risk when I can go and park cash in US Treasuries? So these non-publicly traded oil companies have been, over the last 8 weeks, they've been selling a lot of their assets to Chevron, ExxonMobil, EOG Resources, Pioneer Natural Resources. So there's and a lot of it's because of the lag effects of the interest rate increases, much higher cost of capital for private sector companies that are not publicly traded. I mean, if you're like a large cap publicly traded company like a Chevron or an ExxonMobil, you can just sit back and wait and buy something good.
Yeah, of course. They can definitely play the long game much more so than the smaller companies. Now, crude oil just hit a 4-month high today, apparently. So,
well, the funny thing is also, if you listen to the conference calls from Valero, so the refiners, the gasoline demand, there's still a lot of people traveling, especially Americans. A lot of people there was a lot of pent up demand for vacation, even though people complain about waits at airports and the cost for airline tickets. People were still traveling.
I have to say, I was in a smaller area, like a vacation area this week, and it's been dead for like decades. And I noticed this week that it was just packed with people. So I think a lot of people are just staying close to home, vacationing, or just driving somewhere as opposed to getting on a plane and flying. So that's not going to dampen the demand for gas.
So the oil refining companies here in the United States, they have actually been saying that gasoline demand is basically back to pre-pandemic levels. So we've had a surprise amount of demand here domestically here in the United States.
Well, we also have a lot of people who are like traveling back to work as well. I mean, people aren't like staying at home to work as much as they were.
Well, the other part of this is even though the China reopening has not been to the levels that some people were predicting, you have these other countries in emerging markets, and the demand for gasoline and diesel and jet fuel has actually picked up the slack from China not reopening. So you have like a lot of in emerging markets, a lot of the consumption is not from trucks or SUVs like here in the United States. It's from motorcycles and scooters, smaller mobile, maybe smaller cars, smaller compact cars. And so there's still a lot of demand for that. There's a large amount of fleets on the road. In poor countries, Lee, people are not buying electric vehicles.
No, definitely not. They're buying mopeds and scooters and motorcycles and maybe a small car if they're fairly wealthy.
Yeah. So you've had global demand for oil. It's rebounded a lot. In early 2023, a lot more than people expected. You have refining. The refiners have said on the recent conference calls that domestic demand here in the U.S. is better. The other part of this equation is the oil service companies, and those are the companies that are in charge of drilling for the exploration and production companies. What those companies have been saying is that they have less business booked for Q3 and Q4, which means that a lot of the oil exploration and production companies here in the United States onshore. So deep water offshore is a different beast, especially like in some of the new exploration zones outside of the Gulf of Mexico. But onshore here in the United States, the oil service companies that do the majority of the drilling, they're saying they're seeing way less business booked for Q3 and Q4. So that means a lot less supply is going to be coming online. I would expect then the rig count is either going to stay flat at these levels, and it's already down substantially, as I said a couple of minutes ago, from November 2022 levels, down about 14%, but it could go even lower. So that would not, on the supply side of the argument for oil, there would not be a lot of new supply coming online, and the strategic petroleum reserves that were being dumped onto the market are basically going to stop soon.
What do you think about the mining sector now? Gold, silver, etc.
Excellent question. I was actually just looking through Barrick Gold because I was looking at one of their assets to see, because for royalty companies as a counterparty, and I took a quick peek at Barrick Gold for their costs, and Barrick Gold's all-in sustaining costs for their Q2 numbers on the recent conference call. It looks like their costs are close to $1,400 an ounce all-in sustaining costs. That is up enormously from 2.5 years ago, which were their costs were their all-in sustaining costs, their official numbers, and their investors presentation number that says all-in sustaining costs is very different than if you actually look through their filing, SEC, Securities and Exchange Commission filings for their financial statements. So you can reverse engineer what their actual free cash flow numbers are and what their real costs are per ounce of gold. You can reverse engineer that, and the numbers for a lot of the companies never match. There's normally a discrepancy. Some in the past, when they first created all-in sustaining costs, the numbers were off by like 40%. It's a little bit better now. That was like I've been covering mining stocks for so many years. That was like 7 or 8 years ago. I actually did like a video on that. I probably have to redo the video. And well, actually I have audio editing software. I can run it through my audio level boosting software, the video from 7 or 8 years ago. I went through it. It's in the mining stock education video area, but I can redo the audio with my audio editing software. Anyways, though, Barrick says recently their costs are right around $1,400 an ounce. Newmont, half of their mines. So Newmont's official all-in sustaining cost, I think, is like $1,200 or $1,300 an ounce. However, about half their mines are over $1,500 an ounce. So they
do you think these numbers were reported before the surge in oil price?
Actually, yes. Yeah. The numbers.
So it's got to be even worse now.
It depends if they hedged. So that if they hedged for say 6 months or a couple quarters, they're not going to get killed on oil and diesel. So if they locked in a lower price, it depends. The problem is they may have had to pay a lot of extra capital up front. So the mining companies, for our listeners out there who are not familiar with them, the gold and silver miners, copper miners, base metal miners, a lot of these, especially mining companies, the mines themselves are not in developed countries. Most of them are in emerging markets. And those countries on a relative basis have had way worse inflation problems than the United States and other developed countries. So those workers want higher wages. So even when commodity prices were falling, those economies where the mines were in emerging markets were having higher inflation problems and the workers wanted higher wages. So you were seeing scenarios, and I was looking through past quarterly reports for Newmont Mining where the labor costs were up 30-40% over 12 months.
I don't see it getting any better anytime soon.
Well, the other problem for a lot of the miners, so unless you're a really large miner, low cost one, a lot of the other miners, their cost of capital with these, and this is a major theme here that a lot of the deflationistas just don't talk about, is when the Federal Reserve Bank raises interest rates, that normally means less supply because capital is higher. So if you're a mining company, an oil and natural gas company, if you're an exploration driller, Lee, for oil or natural gas, and your cost of capital because of interest rates are sky high, do you think you're going to spend tens of millions of dollars drilling exploration wells?
I was going to say you're not going to be wildcatting much at all.
Yeah, zero. Yeah, well, unless you're a low cost producer, say you're a Chevron, right? So if you have free cash flow, you pay out a dividend, your senior management, your board of directors, your shareholders will probably allow a smaller percentage for exploration drilling. They're not going to allow you to go and spend hundreds of millions or billions of dollars on exploration drilling, and it's even worse for.
Yeah, I said it wouldn't make sense at all.
Well, it's even worse for a smaller company. So those larger companies are lower cost and have more diversification and free cash flow. But the smaller companies, I mean, they potentially at this cost of capital, they're risking potentially the company. So if they get in a balance sheet problem, the management team either has to sell the company when they don't want to sell it, or they could turn into yellow trucking. Yellow trucking, the main problem started with the $700 million in debt they took out. Yeah. And then all the other problems were that because they couldn't renegotiate the debt and refinance. And then when you get debt and your cash flows aren't what you projected, you still have the debt to pay off. And then the management team had no good choices.
Yeah, no, there was no easy solutions. Actually, no solutions for them, obviously, at all. And those poor people are going to be suffering from it.
Yeah, so back to gold and silver mining. I think we're going to go sideways for a little bit. If energy prices go higher, I think you're going to see a lot of the OPEC countries take their profits from oil and natural gas, and especially like the Saudi Arabias and those guys. I think you'll see them buy more gold tonnage. So I think it'll create even more demand for gold, but we actually haven't seen any tapering off of central bank demand. There's been no drop. Now, when I think recently, over the last couple of months, there's been small drops after gold prices rallied and premiums went up. You saw private sector demand in China for physical gold. You saw it fall off a little bit, and then the gold price would fall, and then private sector demand would increase again.
Yeah. I'm just wondering how gold and silver is going to do in the era of CBDCs.
The non G7, there was actually a really interesting discussion that was released on Wealthion with Stephanie Pomboy and Jim Rickards recently. And it sounds like the BRICS are working on not a gold-backed currency, but some type of weighting. So it's it's fairly complicated. It's kind of a gold exchange standard. It's not a fractional reserve gold. It's not a full gold standard, fully backed. It's not fractional reserve gold standard. It's kind of a gold exchange standard where they exchange it for we'll see. He's predicting what they're for the listeners, it's over an hour, and Jim Rickards is kind of predicting what the BRICS announcement's going to be in the next couple of weeks. Suppose they're supposed to make an announcement August 20 something along those lines.
I think we should revisit that on a show when all that stuff comes out.
Yeah. I mean, the argument that Jim Rickards made sounds really interesting. I don't know what the BRICS are going to say. I don't have any inside information on this. He probably would know better than me. His government and intelligence contacts and banking contacts would probably know better. I mean, I've heard from other banking sources that this has been in the works, but we'll have that. What Jim Rickards has been saying is also in the works. So we'll see what the announcements are. Supposedly, though, there's 40 countries that want to join with the BRICS in this alliance.
Well, you can't blame them. You really can't. Oh.
Well, I think they just want diversification. I think they don't want to buy a bunch of U.S. treasuries. They don't want to recycle all their trade surpluses, their foreign exchange reserves back into U.S. treasuries and then get screwed over like Russia did with tens of billions or hundreds of billions because they pissed off the
it's been a very unipolar world for a long time. And I hate to say that because I'm obviously a very patriotic American, but it's
well, but would you say though that the people in DC here, the people with 2 or 3 degrees and the woke snowflakes in DC or the champagne socialist hypocrites in DC with ridiculous foreign policy, the warmongers, would you say that they represent you?
No, definitely not. No, they represent basically the Council on Foreign Relations and the United Nations, and this is the central banks, basically the IMF.
And the military-industrial complex, yeah.
Yes. No doubt about that.
If there's war profits to be had, yes. I mean, both political parties. I was just thinking back on this. I was telling my family members this because people forget. People's memories are not long-term anymore. They don't have great long-term memories. They don't think about this. But a couple of decades ago, a lot of Democrats were anti-war, so they were pro-free speech and anti-war.
They used to be, yes, when it favored their position.
Yeah, and now it's just unthinkable because CNN has literally they have a correspondent and a studio right in the Pentagon, and like a lot of their stuff is like pro-military, pro-war, very similar neocon foreign policy to Fox News now, at least for foreign policy.
Oh yeah, no doubt about it. They're all on the same page. So, is there anything else you wanted to cover tonight, Jason?
Let me just check the notes really quick. Okay, BRICS meeting.
I think we hit everything.
Well, I think for the banks, I think we're looking at the next wave of problems now. So I think with the credit tightening, this is going to probably take a couple quarters. I'm not sure if the Federal Reserve Bank, the FDIC, are going to force more shotgun weddings. The 2 weeks ago, like I said, you saw the PacWest, which there's another one, Zions Bank. That one seems to be another one people are worried about. They haven't forced anything on Zions Bank yet, a forced merger or anything. But these regional banks cannot raise the equity they need, even though temporarily the regional banks did have a rally earlier, a quarter, 3 or 4 months ago. They had a stock market rally sizable. But now you have credit tightening, you have downgrades from credit ratings agencies. This is not going to cause rallies. They're not going to be able to sell more equity to fix their balance sheet. So it looks like the regional banks are in the next wave of the crisis. And the problem, I don't think, is just commercial real estate. It's now the consumer with credit card debt, small business loans with bankruptcies. So the problem, and then on top of that, you have depositors fleeing because they could earn what a quote unquote risk-free, I'm using air quotes here, because I think like there's obviously risk here with treasuries too, especially because the interest rate, the yield on the U.S. treasuries, even the new U.S. treasuries, in my opinion, is still below the real inflation rate. I think it's around the CPI now.
Oh, yeah. I don't think the treasuries will ever keep pace with inflation. I just think that's impossible to happen.
Well, I mean, people are just looking at the CPI. So I obviously believe the real inflation rate substantially higher, but it has come down a little bit from what it was 12 months ago or 18 months ago.
Oh yeah,
The
it's definitely slowed, but I mean, it's inflation is still there. I mean, there's no doubt about it, and the recent spike in the cost of crude is, that's going to filter out into the broader economy and affect the cost of goods.
Okay, so the last story we missed two quick stories here, China and Mexico. So the
Oh
trade
right,
data.
yep.
Yeah, so we actually have interesting trade data numbers that just came out this week. Imports from U.S. companies importing goods from China are actually down over 20%.
But they're up for Mexico, and Mexico's become the United States' largest trading partner now.
If you think about it, this makes sense because over the last 2.5, 3 years, you saw a lot of people. I don't know if it's all Peter Zeihan. He's the one with the largest amount of YouTube videos on this. YouTube videos and views. He's the one that's getting paid what 6 or 7 figures to go and speak at conferences and do all these TED Talks and all this stuff. And probably getting paid large consulting money to give presentations to the large corporations. But you're seeing large corporations diversify their manufacturing, their factories, their supply chain, and leaving or at least opening new factories outside of China. So I think we're seeing this in the data now. So we've seen this talked about for years, that there was too many problems with the just-in-time supply chain. We can't be relying on China for all the manufactured goods because the Chinese Communist Party and other policy measures could shut down supply of key goods. I mean, 10 years ago or 12 years ago, they did this stuff with rare earth elements. They could potentially do it with other stuff. I know there's a fight right now over semiconductors, right, and other key chips. So there's been talk for years of diversifying the supply chain, but it looks like we're finally starting to see that in the data recently.
I think there's been some political rumblings between the two countries, and if you think back to like when we first started doing this show, how bad the supply chain was, and we had ships lined up to get into port from like they had to wait for weeks to months to get in. So I mean, it makes sense that that would shift away from that dependency.
Also, I think people don't realize how bad in financial shape a lot of the cheap good manufacturing in China was with the tariffs that Trump put on. I was hearing stories from contacts in mainland China, bankers in mainland China, and others that were just telling me stories that the tariffs that Trump put on basically made a lot of Chinese manufacturers have absolutely enormous losses. So,
Wow.
and I mean, people can go back in the archives. I interviewed Dr. Paul Craig Roberts, who was like assistant U.S. Treasury Secretary decades ago. I think right after Trump won the election, and he was adamant that Trump wouldn't put tariffs on China. He was like, "You would never do that. That would potentially be a war and all this stuff." And then Trump did it. And then the Chinese manufacturers, a lot of them were potentially close to bankruptcy, or they needed secret bailouts from the Chinese government and the Chinese banking system. So it was just a mess there. There's actual recent stories, Lee, that Chinese manufacturers now and the Chinese government is actually going to be doing ghost factories. So just to keep their economic data up, they're going to actually allow or subsidize
Oh, brother.
or
Yeah.
bail out. They're going to run these factories and produce stuff that no one needs. So they're going to have like the workers. The workers is kind of Soviet Union.
No
Central
doubt
planning.
about it. There was an article, I think I forwarded to you about the electric vehicles that they did this with, just to keep up the numbers. And there were like these deserts of deserted electric vehicles, brand new, just sitting there.
This is the problem with central planning in general, and the U.S. government's doing it. There's a history of it. It causes immense waste, fraud, corruption, and abuse, enormous misallocation of capital. But
Yeah.
the main part here with the trade data is you're seeing the supply chains diversified more.
And closer to home. Which I think I wonder how much the price of crude oil plays into that too, because it costs money to ship goods from China here, much more so than it would from Mexico.
You also saw, I think, in the last 6 months, I think you saw a decent number of factories open here in the U.S. and the Midwest, but not a lot of human jobs. I think a lot of them are going to be automated, which is it's still better than nothing. I mean, I'm sure the PhD economists will make the GDP numbers look better than they really Then they really are. The other part of this, a couple weeks ago, there was a small regional bank that failed in Kansas, and people were like wondering, why would a regional bank fail in Kansas? But actually, Lee, that was connected to the wheat crop. So that Kansas had their worst wheat crop yield in 50 years. So I'm guessing that regional bank in Kansas that failed a couple weeks ago, I think a lot of that, well, my educated guess is that they had a large amount of their loan book outstanding to farmers, and then the farmers couldn't pay back the loans because their crop yields from the bad wheat crop, they didn't have the cash flow they were projecting to pay back the loans.
That makes a lot of sense.
Yeah, so this is the lack of supply, and Aaron and I have been talking about this in our mid-year wrap in the last couple of weeks. Well, actually, it was a couple weeks. Yeah, it was a couple weeks ago in July that we expect food and energy prices some type of rally, even if the global economy goes into problems. And a lot of it's on the supply side. So you're seeing crop shortages, crop failures.
If you remember, Jason, just a few months, it was probably a while back now, we were talking about the supply of nitrogen fertilizer and how that was being squeezed. So it certainly makes sense that there would be much lower yield production this, coming this time.
There's rice shortages too. Earlier in the year, there was a number of countries that had rice shortages. You still have the problems in Ukraine. Ukraine's a breadbasket for a lot of Europe, and they're not planting the normal amount of wheat there either.
They just can't because their fields are getting blown up. Oh, brother, what a mess.
Well, yeah, normally you need peace, right? You need peacetime, you need quiet, peace and quiet for a farmer to do a normal planting season. I mean, unless one of the militaries that's in Ukraine is going to actually be guarding the fields, similar to what the U.S. military did. Well, I'm not sure if I should be discussing that on a podcast. I was going to bring up how, like, the U.S. military, like from accounts of soldiers, how the U.S. military was guarding the poppy fields in Afghanistan.
you might get done an X mark on you from YouTube for saying that, so you might want to get that one out.
I didn't mention any of the naughty words. So
okay. All right, Jason. Is there anything else you think we should cover? I think we've touched on pretty much everything.
Well, to end the show here, I think we're going to see another wave of potentially inflation. It's going to shock people. I think we're going to see another wave, especially if energy prices rally. Cost of capital is higher. So in the short, you could see, because of all the distortions from central planners, governments, central banks, you could see a scenario where you see private sector companies fail, and then that briefly creates a problem, and then more supply comes offline, and then the lack of supply, the politicians or central planners send out more stimmy checks or other stuff, and that creates even worse problems with stagflation and shortages. So we could see kind of another mismatch, repeat mess of 2020 and 2021 again. It would not shock me.
Yeah. Well, let's hope for the best. Prepare for the worst, as they say.
I've lived in DC way too long, over 20 years, to expect the best from people around here, at least.
I'm not expecting much here in New York either, honestly. All right, Jason, have a great night. It was always good show as always.
And thank you for listening to episode number 22 of Finance Unspun. I think we're going to probably see a bottom here in commodities in the next couple quarters, and looks like energy is going to be a main. We may have another nice bull run in energy for the foreseeable future. Looks like the bottom is in, especially on the supply side, the lack of drilling of new supply for a lot of the oil and natural gas wells, especially here in the United States onshore.